Hi guys, welcome back. What a strange day today, right? Yesterday the market did a huge diving because of the minutes of the FOMC meeting. It says that might be increasing the interest rates earlier and actually start to reduce the debt. With this news, everything was falling together, including the S&P 500, Nasdaq, and Russell 2000, right? It was pretty scary sell-off yesterday. So I reminded once again to set stop loss, but don't cut at the bottom, because even though it was selling off so much yesterday, I said at least wait for the support at 465, and there should be a rebound after that where we can think about what to cut. And as you see, this morning we got to 465 quickly and bounced back up after that. Everything had a nice rebound. Now what's funny today was that even though Nasdaq was slightly down in the end, a lot of the tech stocks continue selling off. But who was holding up the index, right? And among the top 5, 3 of them are Chinese stocks. First one, Pinduoduo, PDD, JD, and Baidu, which I said I was buying the dip on Tuesday, right? Turned out to be the leader of the rebound today. So why is Nasdaq going through a correction, but the Chinese are running up like on fire? And the answer is very simple, because they need to hold up the big index. It has a need to rebound, but most of the other big techs have been running up so much in the past few months, and the valuation is very, very high. So what's left is these Chinese mega caps that they can buy the dip to hold up the index. So now the question is this sustainable? Where are we gonna see things moving, right? Should we be concerned about the FOMC meeting, the rising interest rate, and what does it mean for Chinese stocks? First of all, I think it's not gonna be sustainable like this. It cannot last forever to have only the Chinese stocks that supporting the index. If it needs to run up, they all need to run up together, like most of the bigger techs. And right now, Apple's uptrend is kind of broken. You can see the MACD divergence. Share price make higher highs and MACD doesn't make higher highs. So there is a good chance Apple might be getting into a little bit correction, at least until it gets back to the 160s level. So if Apple can still drop, then maybe the index would go with Apple, because Apple is kind of the leader of everything, right? Amazon still on a downtrend, but the good thing is that it was breaking out of this downtrend a few weeks ago, and right now we're exactly back testing the support of this trend line. Very precise. So at least that's good. Google has completely broken the uptrend from the movement yesterday. Seems like it needs to get into a medium-term correction. And same thing with Microsoft. Facebook has not yet broken the uptrend, it's still making higher highs, and right now it's just a healthy back test. In fact, this range might be even a good range to buy the dip. So out of the FANGs, 3 of them might be in a correction and 2 of them are at the support level and need to rebound. And because the FANG already makes up a large chunk of Nasdaq index, so judging from the movement of these 5 big techs, then I would assume Nasdaq might move up and down on the side for a while, maybe slightly downtrend, judging from the FANGs only. Might take a little bit time. Meanwhile, maybe the smart money would move the capital from the previous hot sector, which is the FANG, into the value stocks or the stocks in the Dow Jones, like I said in the previous videos. So I said pay attention to the Dow Jones sector, especially the ones that have not grown yet in the last year, like Disney, Boeing, and Salesforce. Salesforce might also get affected by the Nasdaq more, even though it's at a good valuation. On the video 2 days ago, I pointed out the good dip opportunity for Salesforce, ranging around the 230 level to 220s. And yesterday, because of the big dip, we have got into this range. I think still at this range, it's good risk reward ratio. So let's say in 1 to 2 years, I think it's a very little chance to lose money in this range with this cost. So if you grab the dip this 2 days in this range, I think you can hold on to it and maybe add more if it dips more and set a stop loss at the 200 level. Because I think even if the tech stocks need to correct, there is limited room for Salesforce to drop because it has been correcting for more than 1 year already. That is my view. And the other one is Disney. So if tech stocks or Nasdaq would correct, it would give more opportunity for the Dow Jones sector, and Disney is one of them, as I said in the last video. So should we be worried about this? Is this going to be a medium-term correction yet? The one we have been anticipating or waiting for the S&P to dip 10 to 20%. Well, first of all, my belief still remains the same, that the US market would not crash until the COVID goes away. And I don't see COVID going away in the short term. So if anything, it would just be a normal market pullback like normally. But I do have a little bit concern though, not because of the FOMC, because I think most investors already priced in the rising interest rate already. So yesterday was a little bit over-exaggerating. But what I do have concern is the fear and greed index. Because yesterday the sell-off was pretty quick and deep. And yet the fear and greed index is not even in fear level yet. So this is what I'm concerned about, is that people are so used to buying the dip, thinking that it always would go back up. So if anything, this is a little bit concern I have. But other than that, right now the S&P is still running healthy, is still in an uptrend, hasn't even backtested the blue trend line yet. And the only thing lagging is Nasdaq, which might be only because sector is rotating and the big techs are correcting. But for the S&P, I don't see big risk right now at this point. Especially we're having a medium-term election in the US, and I really don't think the Fed would let the market crash towards the election. So even though it's volatile, it's still on an uptrend. And at worst case scenario, it would just move on the side, up and down a lot. That would be the worst case scenario I can think of. But again, I think most investors have learned the lesson last year in the 2021 that the fact that S&P is up doesn't mean all US stocks are up. I think the US stock market is getting more and more like the Chinese stock market, so driven by the politics. So it could be just the Fed or the bigger institutions holding strong the S&P so the market remains calm. So all the capital mainly focus on those bigger stocks that hold the index. So what will happen to our Chinese stocks? I think today was a very good example that even though the US stocks can be in correction, the Chinese stocks can come out and hold the index. Because today they are all bouncing back up very strong. PDD is up at some point almost 10%. BABA was on fire again. So overall, in the medium term, at least in the year of 2022, I think the Chinese stocks can outperform the market stretching to a longer period. But of course, it would dip when the US market dips. Now, a few Discord members ask me why the Chinese growth stocks, the smaller caps, are not rebounding as strong as the bigger techs. And the reason is because last year in 2021, most of the bigger techs were selling off even more than the growth stocks. And at the same time, they do give more certainties because they have sufficient cash, they're already making profit, they have the PE to support the fundamental, the share price, and extremely oversold. So there is no surprise why the institutions would buy the dip of the bigger techs first before they would move on to the growth. So that's why recently I suggest to put part of your portfolio in the KWEB because it composes all the big techs like Tencent, Meituan, Alibaba, Baidu, JD, Pinduoduo, and so on. And on top of that, most of them already have a second listing in Hong Kong or primary listing in Hong Kong. So that would reduce the delisting risk as well. So you can see today the market was mainly flat and CWEB grew at some point almost 12%. It was significantly outperforming the market. On Tuesday, I said I bought the dip for PDD because I was aiming for the support of 49. And today it became the number one in the list of Nasdaq, surprisingly strong. So I already took profit of the short-term call option today. Baba recently have been making higher highs and staying flat even though the market is moving up and down so much. So I was speculating that there are bigger institutions accumulating shares quietly, even though a lot of retail investors are dumping. And yesterday we saw the news that Charlie Munger once again doubled down on the Baba investment. It's been 3 quarters that they have been adding constantly, even though a lot of people are judging what they're doing right now. I heard some voices saying that, oh, Charlie Munger is too old, he doesn't know what he's doing, this is the only stock that he's gonna fail at. But it seems like he's really putting all those noises behind and focus on what he believes in. I think he's quite bullish in the China economy, the Chinese growth story, and did not doubt for a second that Alibaba is a good company, regardless of the political risk. So what does he see in Alibaba that normal investors don't? So Baba had dropped so much last year, and the government interference is only one of the factors. There is an important factor, which is because the main business, e-commerce, is losing a lot of the market share because of JD and Pinduoduo or other new players. But Alibaba is also investing a lot of money and resources into the new businesses, like the most important to be the cloud business. And for me personally, other than the cloud business, I'm also very bullish on their blockchain technology. As I repeated many times, that Alibaba might be the largest blockchain patent holder in the whole world. And you know that I am very, very bullish on the blockchain technology. I know that this is one of the most important tasks for the Chinese government for the next 5 to 10 years at least, other than the new energy. If you are a long-term follower for my channel, you know that I'm non-stop on the China's new energy big plan. And the bigger plan behind this might be blockchain plus new energy. This combination makes me extra bullish. I think this is the biggest winner in the next 5 to 10 years. And instead of investing in the smaller blockchain stocks in China, which have such a strong correlation to Bitcoin that the Chinese government banned, right now I think I'd rather invest in the bigger stocks in the blockchain field that can help support the digital currency, the digital RMB. So I think Baba is definitely one of them. And on top of that, there was a very good news that maybe most people have missed. It is that the Chinese state-owned company is investing in the Ant Group, so taking a large ownership. So that means finally Alibaba and the CCP are reaching a common ground by owning shares of the same company, which is the Ant Group. Just for this, it has significantly reduced the political risk of Baba from here on and making it much more investable. Because since the government has a good ownership in the company, it's very unlikely they want this company to go away. In fact, I do think they want Alibaba to help develop the digital currency project, which is the most important project. I think this actually is not a bad news at all. I think it would make it much more safe, reducing a lot of the political risk. Now let's update a little bit on Baby NIO. So after the strong breakout last Thursday, right now we are back down like before. As I said on Tuesday, you need to have a stop loss for NIO ready, because in case it breaks the 31 to 30.5 level, it might turn downtrend again. So right now in the Chinese market, the EV stocks and the solar sectors are still in the correction. So there is no surprise that NIO is dragged down with it. You can just look at BYD for indicator, or the CATL for example. If they are in the correction, then the whole sector should, because they are the leaders in this field. So for now, I would say for Chinese stocks, KWEB is the way to hold on to. But once the EV sector and the new energy sectors finish correcting, I do see the EVs and solar plays up and running again. Especially you can look at this support level, 28. Technically, 28 should be a strong support. But recently we have been backtesting it 1, 2, 3, 4, 5 times. So when a support level has been tested so many times, there is a chance it will break. And if it really breaks, then it would go to the next support, which I still have drawn here at the level of 24. I hope it doesn't get there, but in case it does, I would be happy to grab the dip. In the end, I also want to talk about the RK indicator. As you see, RK ETF has been going through a huge correction for a year already. Continue making lower lows. That's why if you feel painful recently, it's because you are holding a lot of growth stocks, and RK is a good indicator for that. But I have good news for you is that I think RK is near the end of the worst. I think we are getting really close, especially if it can get to, let's say, the 70s level. I think this would be a good indicator to buy a lot of the growth stocks. And I would say a lot of the growth stocks are sharing the similar movement right now. Last time I shared Pinterest. This time I would like to talk about Palantir. Now, 6 months ago, a lot of my Discord members would ask me about Palantir, but I haven't heard anyone mentioning it at least for a few months already. And usually this is a good sign. It means a lot of retail investors have given up, and usually the institutions might have accumulated enough shares. So it's ready to rebound anytime. Another one is SoFi, ticker symbol SOFI. I think it's also gotten into a good support. So I suggest to look at the RK as an indicator to get in those growth stocks again. Now, in the end, I also want to quickly mention the crypto. I haven't updated crypto for a long time, but now I think it's worth mentioning again. Now, for Ethereum, I suggested at first to buy at the beginning of last year, January 2021, before the run up. And in May, I also called out a golden dip. After it ran off, I did not update it since. So it has been going through a little bit correction as well. And I think right now we are at a good support level that it might be interesting to revisit again. And for stock, you have the ETF ticker symbol ETHE. I think we have gotten into a range where it's good to accumulate slowly, and if it can get to the 26 level, it would be even better. I would think it's a good risk-reward ratio. Now that's it for today, and if you have enjoyed this video, please give me a big like and write me a great comment, and I'll see you in my next video. That's it, guys. Hope you can find my videos helpful. Make sure you subscribe to my channel and give me a big like. Thank you.